Okay. So one fundamental, you're able to see the screen and hear me, everyone? Please confirm.
Yes, sir.
Okay. The disclaimer once again, the stock market information is for educational purpose only. I'm not a SEBI registered advisor. Please consult your financial advisor before taking any decisions on buying and selling of a stock or any investment decision. We are not liable for any gains or losses made by you. The objective of this course is to spread financial literacy. So we'll see what is the moat today. How do we identify great business? Okay. First thing we should understand is, if I put my funds into fixed deposits or mutual funds or debt funds or gold, my returns will be much lesser, or it will be just maximum covering my inflation. In case of mutual funds, you will get little more than the inflation. But believe me, 80% of the mutual funds, as per the reports which we are receiving, are not doing on an average. They are doing bad than the benchmark index. So it is very dangerous to continue with the mutual funds. Okay. So if you want to become an active investor, you have to start managing your funds in a proper logical manner, undertaking both fundamentals as well as technicals. Graham's style of investing is known as the father of value investing. He used to buy small stocks which were very low on price. And then as the stock goes up, he used to sell them. So his basic thinking was buy low and sell high. Okay. Buying business at a discount, even buying bad companies, and he used to sell them and make some money. So that was the style of Graham, which Warren Buffett also started initially with that kind of style. But later on, he changed himself when he was partner with Charlie Munger. Charlie Munger was also one of those who believed in not only in value, but in the growth of the share. So when we buy a small company, a sick company, and when the sick company turns around, it is good for the company. And if it is doing better, you can sell it at a positive values. But supposing the company goes down, Warren Buffett at that particular time, when he started his career, he believed that selling the land, machinery, furniture also can give you much better price than the price at which you have bought that company. So, but over a period of time, as he came in contact with Charlie Munger, and the views were not so positive, because this kind of thinking cannot help you increase your wealth. It is not a scalable at all. Okay. So what he decided was, he and Charlie, Warren Buffett and Charlie, they changed their way of investing. So the investing moved from value to growth. Charlie's style of companies was picking up. He used to look at the companies which were good ones. Even though he have to pay a premium, he was not at all worried about it. That made a change in the way Buffett started investing. Good monies, good companies. Now, if you see that I'm looking at only the PE at 20 or 25 or 30, and then only I will invest, you may not get the good companies at all. So we should be willing to pay premium, higher price for good stocks. Rather than owning a bad company at a low price, it is better to be owning a good company at a higher price. So how do we identify great businesses? I'll just show you a screener which I had shared with you last week. And this is the screener. I'm going to my, and here is the screener. I am changing the parameters and I'm showing you how to go about doing it. I'm removing these parameters. Okay. I have kept only 3 parameters. The stock can fall up to 80%. So instead of 80%, I am saying, let me have a stock which has fallen up to 20%. So 0.8. And I'm looking at market cap of 5,000 crores and above. So what I'm looking at, mid cap and small cap stocks. So I'm giving this query and I'm running this query. Okay. So when I run this query, I get a list of 167 companies. So my first filter is only 5,000 crores above, that is a mid-cap company, and the fall should be around 20. You can see the from 52 work high, it is showing 0.83. It is 0.83% or 83% from its high. So how much it has fallen? It has fallen by 17%. So this is a kind of query I had sent to you in the week. Now what is happening? I'm seeing lot many companies. How many of them are there? Around 167 are there. Am I in a position to go and do my 167 company screening on a daily basis, or when I have to buy something? So what I'll do, I'll start adding some parameters. Okay. So I will say, let me show the parameter screen, which I've said it for you. Operating margin of 10 years. 10 years is about 10%. Average return on capital employed about 10. This 10 years period is 10. On equity on 5 years is 10. All these are the parameters I have put in. When I put in all these parameters, what I'm going to see is I'm going to filter my companies. I'm going to reduce my companies from 167 to something which is reasonable. So here I've put promoter holding should be above 40%, pledge percentage more than 10, less than 10 rather. Interest coverage should be above 5. This ratios we'll see little later when we'll be doing the key ratios. Maybe next week we'll be seeing the first key ratios. So now out of 167 companies, when I put in this particular 80% fall and these fundamentals, I am seeing only 11 good companies in my list. And what are the parameters here? You can see this is the performance of these companies. The PE is reasonable. Now here I've put a PE, I'll add the PE now, and PE, price to equity, to earnings per share, sorry, price to earnings per share less than 50. I don't want very, very costly companies. I'm looking at companies which are fairly valued. This is still costly, but still I don't want to miss out my good companies. So what I'm doing now, you can see here, I have further reduced. Now what is happening? All these companies are slightly costly. You can see this about 30, 37, they are costly, but still these are good companies. Coromandel International is one of the companies which I have suggested last week. Okay, so you can see that has come as a filter here. Now, if I want to try my luck at some more companies, so I will say if they have fallen by 30%. So here is the change. So from 11, it has now become 16 companies. Okay, now I want to look at fundamentally good, but they have fallen by 40%. So I'm changing the query once again. Fundamentally, they are still good. The companies have now become 24. So that way, you can change your filters, you can change your screen, and you are in a position to get the company's name, the first level of. Then what I should do is I should go back and then look at each of these companies. So supposing I want to look at Mindtree, I will go back to Mindtree. I'll click on here. I'll see the Mindtree stock. So here is Mindtree. What is the intrinsic value of the company? 1485. But the company is current price is 3,000, nearly double. You can see here double. The PE is 30. Please remember this stock was having a PE of somewhere near 45, 50. I can show you the PE here. Some months back it was here, 53, and now it has come down to something like 30. So you can see now this was very highly priced, and that is why there is a fall. From Jan, it has started falling, and now it is coming to a reasonable price. But here you can see the median line is 24.8. This stock should have been around 24.8%. So here is my median line, 24.8, and the stock is currently at around 28.30. Here it is 30. So if you're looking for a stock to come down to the proper value, it may not happen that Mindtree will come down to this value. So sometimes we have to make an adjustment in our buying pattern, because if we wait for the stock to come down to the price which we want, it may not happen only. Now, return on ROC, ROE, all these factors you have to look in as a part of your filter, and then you decide. Now see the debt. Where is the debt? The deep debt to equity is 0.1. So it is less than 1%. It is much better. The PEG ratio is 1. Say niche hona chahiye. It is less than 1. It is good. Profit growth is 48. Sales growth is 32. Pledging is not done at all. Patriotic score out of 9, 7 is very good. It is good. Current market price to free cash flow is good. So the price ke comparison mein cash flow is also good. So with all these things, what you see, only cost problem is the stock is very costly. Costly because you can see here, PE is high, PB is 9.28. What does PB means? Price to book value. So if my book value is 1 rupees, my stock is being selling at 9 rupees. Okay, it is very costly. So, but still, if you are a person who believes little bit in growth momentum based investing, then you will definitely go for this kind of stock. Then you can see market cap to sales. This is another ratio which tells me that here is my median line. Median line is over here around 2.3. Where is the median? Here it is. And where is the company stock value? The company's stock value market cap to sales is 4.8. So the median is around 2.3 and the current value is 4.8. So even market cap to sales tells me that the stock is little highly priced. EV to EBITDA, this is another valuation ratio, which is currently the median is 13.8 and the current value is 18.7. So still, if there is a correction which takes place in the market, there is a possibility that Mindtree can come down little more. Okay, let us go back to our presentation further. So how do we identify the great businesses? For identifying a great business, we have to create our filters. I showed you the screen, the filtering. Some filters which Buffett created was based on the ROC, ROE. And what he says that I am not a genius, but I am good at certain things and I do them well. So what he does it, he understands the economics of every country. He understands the sectors, industries, and the business, and then he does the investment. The basic thing is we should not keep on trying too many things, otherwise we'll get confused. So understand the stock and the business, and then we'll be better. Stock investing should be considered as an investment in business rather than doing some kind of buying and selling on a price basis. If you do a proper evaluation, then you will be able to succeed much better. Like if you are to buy a house, you will do much more evaluation. Same way, when you're buying stocks worth 40,000, 50,000, 1 lakh rupees, you should be doing a lot of evaluation in the fundamentals, technicals, and then do it. The fundamentals will tell me what to buy, and the technicals will tell me when to buy and exit. So in a game like baseball, we wait for the right ball and then we hit. So that is nothing but the sweet spot. So stock based also, you should not buy everything. You should not chase everything. Wait for the right stocks. In a bullish market, you will get good number of stocks. Like you may get 200 stocks, you will filter them and further you will reduce them to 50, 70. And finally, you will reduce them to 10, 20 for your portfolio. But in a bearish market, you will come to know the quality of the stock. Bearish market will actually tell you which stock is doing well, which stock is having fundamentals well. And there you will not get good number of stocks, you will get less number of stocks, but it will still tell you how you can do better. You can buy and sell as per the market requirements, make money. Consolidation markets, you'll do more of swing trading kind of thing. Buy at the low levels and sell at higher end. So one should understand the industry, the sector, and then look at the stock. In stock markets, there will be good number of chances. A lot of stocks will be thrown at you. Don't buy everything and anything. Wait patiently for the filtered stocks. Okay. Don't keep on looking at money and the greed as one of the reasons. Don't get worried about FOMO. Stick to your process and don't become emotional on any stock. If the stock is going down and it is down by 25-30% in your swing or positional trade, you should have already removed at 10-15%. But you are still holding. What you are doing, you are converting a loss-making stock into investment opportunity, and which may not happen. So we have to look at moats. What is a moat? A moat is something what we identify, as Buffett said, something like a sweet spot. So we have to filter the stocks on the 4,000 stocks, 5,000 stocks. Use some filter methods and you will be able to identify which are the companies which are doing well. So performance fundamentally, and the other aspect is how long the durability will be there, how long the competitive advantage is sustainable. Good number of economic moats will be there, and those stocks will be available to you at reasonably little higher price, but they will be giving you much better returns. Big businesses are like big business kingdoms, and they definitely have a big moats develop over a period of time. And definitely they will be little costlier also. Market leaders will always be at a high end of the pricing. The runner-up companies below them will try to hit them, okay, try to gain their market share. This term economic moats was coined by Warren Buffett. How do we identify a moat? A moat is something like, in the olden days, a castle is there, a fort is there, or a township is there. Big walls are there, high walls are there, and there is a water, okay, a kind of a ditch which is kept surrounding the castle, where the defense is built up. The enemy is not allowed to enter the fort. So a business moat is nothing but a competitive advantage that a company gets over a period of time. So a wide moat, a company having a big moat, a longer and relatively stable moat will always be having an edge in the industry. So moat in general is nothing but the ability of the business to remain competitive for a longer period of time. And when it is competitive, it will always see that the market share is not going to fall. Currently, you must have seen that FMCG companies, even though the margins were reducing, they were not giving up on the FMCG. They have increased the price by very few percentage points, but they don't want to see that the market share gets into trouble. How to identify a moat? From the company's point of view, a small timer, you will start a business into service industry, retail industry, software, low-end, coaching industry. All these are things, they will not have any moat. Anyone can start a similar business and will be able to swallow you up. So these businesses don't have any kind of a major moat. Most of the small climbers, small industries, small business people will look for similar kind of moats. But these are bad moats. They cannot be. You should have a moat where there can be a definitely entry barrier. So if you don't have an entry barrier, then you will not be able to challenge that. Anyone else can come and start a business similar to yours and will be able to overtake your business. In the portal's 5 principles, basically, we'll see that how Michael Porter has defined the different kind of ways in which we can have entry barriers. So think of those businesses where there are good amount of entry barriers. That will define your moat. If there is a business where the entry barrier is very, very poor, then you will not be in a position to actually have any moat at all. Now, a grade A company like a Pepsi company or a Coca-Cola company, they can easily, because of their size and the number of years, the money sunk in that business, nobody can compete with them. You must have remembered that most of our local players like Dukes, Rogers, Tinsha, Parle, they sold their businesses to Pepsi and Coca-Cola. Okay. So is it possible to attack a company who is serving 2 billion servings per day? Today, these companies have lot many products apart from the cold drinks. So Moats is nothing but they have the pricing power. They are easily able to manufacture. They can increase or decrease their prices as and when they want. They have a good profit margin. They have a very high market share. Is Coca-Cola having any kind of a competition except Pepsi? Nothing. The worldwide, these are the two companies only. So when a kingdom grows, the competitors will start attacking this company. Okay. Similarly, we have cigarettes, hard drink companies. They have similar modes. Advertising is not allowed in these products, but still there are ways in which people advertise in innovative way of doing it. So here we have the Coca-Cola, Pepsi company. Then similarly, we have the Domino's, McDonald's, KFC's. Moat can be many ways created. We'll see them one by one. What you have to define is how much is the competitive advantage the company is having and how long this advantage will be durable for the company's long term. That is going to define your moat. So let us see. One is a cost moat, where the switching cost is there, which is high. Already the business is operating, a lot of money has already been spent over a period of time. And that now is an advantage to the big companies like HUL, TCS. They have got a lot of moats. Pepsi company. An example, if you are going to Gujarat, there is a company called Santa Cola and there is a Pepsi Cola. If the Pepsi Cola is costing rupees 25 and the Santa Cola is costing rupees 20, will you buy this Santa Cola? Because you don't mind spending 5 rupees more because it is low on wallet. It is not going to cost you more. So moats are created as a low cost product. So if any of the products are very low cost, you know the small sachets in which all the farsans are coming today, they are hardly 5 and 10 rupees. But the number of people buying them is very high. The reach is very high. Similarly, the shaving products, the toothpaste and all, they have come down in small units. So if the moat is such that the overall wallet cost is very, very low, then such moats are really helping us to do better. The classification of moat is the grade A moats will have a taste. Okay, all these are the grade B moats are the ones you can see all the biscuit company, chocolates, they all are having different tastes and you will go for the taste. You will not give up anything on the taste. You will go for those kind of companies. You don't mind spending a little more. Even small children will also have like the younger ones will look for Kinder Joy. They love this kind of thing. Grade B most are similar companies but without taste, like your mobile companies. If you were to buy a mobile which is costing 75,000 and buy a Samsung or Realme or anything like 10,000, now this is a costly product. In such a case, for you want to have a cost-effective buy. You want to save that 40,000-50,000 on the mobile. So you don't mind spending 20,000-25,000, but for buying an iPhone, you will think twice or thrice. So there are grade B moats which are costly and there are moats which are on the low price. So sometimes we may go for a low end product, but there are people who buy this kind of Apple iPhones. They are brand consumers. They love the cost ones. Okay. Some of them will always go by the brand names. Some companies have an advantage of a switching cost. Now, supposing now that portability of the mobile number is okay, earlier when this was not there, switching from Vodafone to Airtel was a problem or to Jio was a problem. Now we have the mobile, like portability is there allowed. You can move with the same number from one company to another. That has become a better thing. But will you move from Apple laptop to say Microsoft kind of system? It is difficult. Similarly, from a mobile which is having the Apple OS to Android OS, it is difficult. So another kind of moat, which is the size in the company. Some companies over a period of time have created a very, very major size. One of them is HUL. It's a very big company. Okay, Chinese companies are very big. They have enjoyed a large size. Okay, their overhead costs over a period of time have reduced. So they can easily overcome the small companies which are coming in their way. Most of the Chinese companies are having very large sizes. Today, India is challenging many of the Chinese companies. So Gillette is one such company which has there, and it has no competitors, okay, in the razor industry. Then another one is high switching cost mode. You cannot shift from one company to another so easily. So the IT companies which are doing services and all, they have this advantage. A company cannot move from a TCS service provider to a Infosys or like that, because there is a movement, a transformation which is happening. It takes months to get it right. So if you are with one of the industry leader and you want to shift to somebody else, it becomes a very high cost switching. Mobile service providers, one email ID to another, one bank to another. These are examples of high switching costs. Moving from one ERP to another, moving from one outsourcing to another vendor, moving from work from office to work from home. These are the different ways in which we have a cost. Similarly, we have a cost advantage. Most of these companies have a very great cost advantage. So some big banks and all. Now, one important fact which you should know is that the private banks once upon a time replaced the PUC banks. But today, the private banks are getting replaced by big companies like Bajaj Finance and Bajaj Financial Services. Okay, so all the NBFCs like Cholamandalam and all, they are actually replacing the private banks. So there is a change in situation which is happening. That is why many of the private banks are not functioning so well. We have the cultural moat, like the brand, the tradition. Some companies have the brand, the leadership position is because of the brand itself. Some company has a people who are leading the company. They are themselves are the name by themselves. Okay. Similarly, we have the low cost brand recall distribution networking companies. Some FMCG companies like Maggi. The Maggi is coming from Nestle, and we know that even though Nestle had a bad time some years back, about 5-7 years back, because of some problems they faced with their product. But after the ban, Nestle has come back to the original position. Similarly, we have Hindustan Unilever, consumer durable companies. Okay. Now companies like Dukes, Mangola, Rogers Mazda, they were very good products once upon a time, but they were ultimately taken over by Coca-Cola and Pepsi-Cola companies. Then soft moats company like corporate culture, traditional values. Okay, these are companies which have a name. People will vouch for those companies. Like Tata's, the Birlas. They have the leadership, they have the corporate environment. The HUL is a training ground for many companies. The Bajaj Group. So all these are another moats by themselves. So IPR, knowledge, regulatory, the pharma companies, that patents, the media companies like Saregama, the music companies, they are doing well currently, Spotify and all. Then companies with the chemicals and the pharma industry, having the APIs. So if you are not moving, if you're not changing your technology, if you're not spending on R&D, you can be in trouble. But if the R&D is successful, you will be taking advantage of the R&D. But if they fail, then you will be doomed. Like it happened with Nokia, Motorola, Ericsson. They lost in the mobile race. So R&D is a very important factor, but to be successful is important. Companies like BlackBerry and Nokia, they went out of the business. Okay. Similarly, Kodak, Fuji cameras, they were not able to scale up to the other competitors in the digital market. Similarly, Indian mobile companies like Carbon, Macromax, they all lost. A successful name is a Intel name. Intel Inside ad campaign was one of the most successful ones. Similarly, technology products cannot be predicted. Okay, whereas the food company products can be easily be predicted. Okay, Xerox became a well-known thing, okay, for a photocopy. Nowadays, we have the new age companies, which are network-based companies. This is a new moat which has come back in the business. So we have the network company on the e-commerce platform, on the food and travel aggregators, on the social media, data giant companies, GPRS-based companies. One of the companies currently in the market is Mapma India. Here is Indian company, FL India, Grofers, Blinkit, and all are there. Swiggy, Zomato. Online learning and meeting companies, Zoom and all, they have gone down once again because the COVID is now out. The music companies, streaming companies, okay. So these are the typical Indian companies. Some of them are based on the technology. So most of our Indian companies, TCS, Infi, all these are basically looking for a particular kind of platform-based and services-based industry. Okay. Some of them which have lost in the race currently are Subex has gone out of favor. Nucleus Software has gone out of favor. So here is a network-based company. They start with the products. More and more people will join their products, and then they will contribute more data. And that is how the circle, the vicious circle, the vicious cycle continuously increase the performance of these companies. So network effect can have been because of the marketplace, because of the data, because of the platform they are working. Marketplace companies are what you already know: Amazon, Flipkart, Myntra, FirstCry, Nykaa currently, Zomato, Swiggy, okay, Uber, Ola, Ease My Trip. They all are marketplace companies. The database companies, Google is one of the big ones. The platform-based companies, okay, many mobile companies are platform-based companies. Facebook, WhatsApp, YouTube, Instagram, Twitter. The platform-based now we are having the EV, the green power companies, which are in the batteries, the EVs, the charging stations. So all these companies are now started moving in this particular direction. So we classify the taste-based modes as a moat A, where all the biscuit, food items companies, they are nowadays coming in small sachets, and therefore the range is increasing and the reach is increasing. Okay, these are the food A. The B grade modes are nothing but all the companies which are having modes, but they are not including taste. The taste is not part of the B modes. So most of the stock exchanges and all, they come under, most of the exchange companies we are seeing now, they are under C. So in a nutshell, we are looking at modes which will help us to predict the company's performance, whether they are going to be having a sustainable lifestyle, whether they will be in a position to continue for over a period of 5 to 10 years. Predict the future cash flows. What is the present value? Have a margin of safety. Buy those shares. And then when the shares do up, when the shares move upwards, you can start selling those shares. So most of the good companies, they are having the market leadership position, having a good amount of market shares. The new age companies are having a lot of competitive advantage. Structurally, they are thin companies. Many of these companies currently on the Nasdaq, they are down. They are challenging the big size companies. How durable, how long lasting the network based companies will be, only time will tell. We will not be in a position to answer this particular thing. So the second part of the thing is circle of competence. We think that we know this much, the outer circle, whereas we actually know is only this much. So we have to develop our circle of competence. If we know what we know, we will be able to avoid the problems. We will be able to identify the opportunities. We will be able to learn from others. We need to keep on upgrading ourselves. You need to keep on learning in this business. You have to read a lot. So from the years of Warren Buffett way of investing, today a lot of things has changed over the last 50, 60 years. So you have to understand what area you are operating, how much you know, and what you know is the best. You have to be selective on your businesses. You cannot be an expert in everything. You cannot know everything. You have to evaluate companies based on your circle of competence. Initially, that circle will be a smaller circle, but you need to understand your boundaries. That is very important. You need to understand them, where you have to draw a line. Focus only in the area of competence, your area, where you know how you can do better. If you are able to define your business areas, your sectors, then it is a better way of doing business. So develop those few sectors and industries and companies which you want to go about doing it. Evaluate those companies within your circle of competence. The size of the circle is not important, but the quality, the boundaries where you will draw a line is important. Your goal as an investor should be to purchase a stock at a rational value price, fair value price. Be an owner, understand the business. As the company improves, expect the earnings to be higher in the future and you will gain. You have to define your standards and filters as I showed you earlier. Include those companies which will meet the filters. And then study on them, deep dive into each of them. Okay? If you are buying stocks from what you know, you are taking lesser amount of risk. But if you are buying stocks from what you don't know, your risk level is increasing. So have the expertise, understand the stocks. You should be aware of the industry and the sector where you are putting your money. A novice investor will not know much of it. If you know your share, your stock will be like if you are understanding the business, if you have bought some particular allocation, and if you know the share, you will be much safer. But if you're not understanding the business and you're still buying it, it is more of speculation. Protect your capital. Don't make mistakes. If you protect your capital, your performance will be better. Supposing I say I understand banking, financial, auto, IT, and metals, then I stick to this. Don't buy shares where I don't know much of it. Create a circle of confidence, see, define which sectors you know, define which industries you want to go for. Be a long-term person. You may do swing and positional. Avoid futures and options completely. If you are successful in one sector, go deep dive into that. Keep your range to a narrow 5-6 sectors maximum. Do risk management and position sizing. See your risk reward ratios. This is the way in which you have to define your some of the parameters. In one stock, I should not exceed 7% to 10% of my portfolio. In one sector, maximum I can exceed is 25 to 30%. And in my portfolio, I should have maximum 20 to 30 stocks. Secondly, you will be having a core portfolio and a swing portfolio. A core portfolio is 70% of your overall portfolio value, and a swing and satellite portfolio is about 20 to 30%. Avoid areas of conflict. If you don't know much of energy, crude, pharma, avoid them. Avoid commodities. Avoid F&O. Avoid F&O. I'm saying this time and again in every lecture whenever it is an opportunity. Because you may have 2 or 3 good days and 1 or 2 bad days, you will be immediately losing everything what you have gained. I've seen people losing a lot of money here. Know your markets. In the 2021 AGM, Warren Buffett said this. There is a lot more to picking of stocks. Okay, so it is very important how you understand, how you figure out what industry you want to buy. Markets are volatile and unpredictable. The trend can be bullish or bearish or sideways. Whenever the market is sideways, you will have to become stock specific. If it is bullish, you go with the trend of the sector with the tailwinds. If it is bearish, it is coming down. Wait for your right time. A good sector or a good stock, you will be able to identify only in a bearish market. There you will be able to understand what is the valuation of that stock. Improve your knowledge in the industry. Go back to the drawing board to understand what you don't know. If you don't know something, avoid that thing. Only explore what you know. Explore the companies which you know. Stock market is a business where you're bound to have accidents. So how do we do what we are supposed to do? First thing, you should know what is the area of circle of confidence, how much I can. So start with a small list of 30, 50, NSE 30, 50, and then expand to 100, 200, 500 companies. Go with the large caps to start with, about 20,000 crores. Then you can go to 5,000 and 20,000 crores range. Avoid this in the beginning. They can be very good and they can be very bad also. If the market is going up, small caps and micro caps will go up with the market. But if it falls, it will fall very drastically. Start with a small number. Define your circle of confidence. Avoid businesses which you don't know much. Go read the annual reports, read them thoroughly, and then you understand it is. If you understand, it is good. Otherwise, avoid them completely. If you don't understand something, try to go deep into it if you want and whenever you have time for that. The circle of incompetence in the initial will be big. So in the initial period, you will always find more things difficult to understand and less thing easy to understand. So go by what you know. Don't go by speculation. Don't go by people telling you to buy this or buy that. And then over a period of time, try to improve on these levels. my approach in doing with the fundamentals and technical. I use the top-down approach for defining what are the economies, the market caps, the sector, and the industry. Which are the key companies? What is the growth and the profits? How they are facing them? Will the company survive? The longevity, the durable competitive advantage position. Do not go by this news-based events investing. Like somebody has invested or going to make a capex, and suddenly the market will fall in that product. So you will be able to keep everything. Don't go for too many IPOs. They can give you a lot of pain. IPO should be bought after 5 to 6 months when you see the company is doing really well. Take the case of Zomato. Take the case of Paytm. You'll understand what I'm saying. Mutual funds, stick to large caps and balance funds or multi-cap funds. Mid-cap and small caps have not given good returns. Screen the stocks based on the data. That is the second step. Define your screen filters. Go deep dive into each sector and stock. See whether a stock is having a tailwind or a headwind. Stock should be picked up with good scores. Have your filter scores. I am referring to the following websites, which will you find many of them are there. And most of them I'm subscribed already. Screener, Trendline, Markets Mojo, MarketSmith India, ET Markets, Stock Reports, Tijori Finance. This is not subscribed. RateStar I have not subscribed, but the others I have subscribed. Study for each stock, the fundamentals, whether they are good or average. If it is bad or poor, don't go for it. Valuation, moderate. Sometimes we make a mistake of buying expensive stocks, then we regret, including myself. Current quarter performance should be improving. It should be good. The last 4 or 5 quarters should also be doing better. See the trends of the company, whether they are doing better or not. Technical analysis should be bullish or maximum moderately bullish. Identify your buckets. These are the 5 buckets. Okay, whether the price is good, the returns are good, the CF cash flow ratios are good, the returns ratios are good, the market cap and the sector is having tailwinds. It is helping the stock to move up. Corporate governance, clean accounts is very important. You'll realize that if you read a book called as Diamond in the Dust by Mr. Saurabh Mukherjee, and there are 2-3 other authors, you'll realize that what he mentions is there are only 20-30% of the companies who are having clean accounts, not fudge, not having any kind of major financial Shanghai's point of view. So use these tools, what I should say, and undertake in-depth analysis. Summary, build your confidence levels, build your circle of competence. Do not exceed your boundaries where you don't know much about it. The circle of confidence, the knowing what in the business will be, initially you will know much lesser than what you are knowing it. So circle of not knowing will be always large to start with. Slowly and steadily over a period of 6 months, 1 year, you will improve. Understand the boundaries. Please understand the boundaries. These boundaries will help you to take a decision where you wish to go further. Read a lot. I read that. I go to various sites and I update myself. Before giving a particular any information on a particular stock, I go through my level, the 4 levels, the 4 approach methods. Okay. Keep yourself motivated. The market situation may be bad currently, but it will improve in next 2-3 months time, maybe a quarter or 4-5 months maybe. So November, December is what I'm seeing. The things will change. The odds of success in business as well as in life is defined by the parameter of your confidence. If you don't understand the business, accept that and move to the next one. Over a period of time, when you start researching on the stocks, when you start reading on the stocks, you will be able to gain the level of confidence. I, for one, don't understand much about the chemical, the API industry. So I continuously read on them. So nowadays I have understood something about this industry, the pharma also. I avoid many pharma stocks because of this reason, because they are dependent on the US FDA and all. And suddenly some kind of observations will come in the way, and you will find Divis Lab going down, or Dr. Reddy's going down, or Sun Pharma going down, because of not internal reasons, but external reasons. So this is the area which I try to avoid unless I know it is a good one. Like the hospitality industry, you must have heard about Apollo hospitals going down recently. Okay. So this is what I'm supposed to do for today. Anyone wants to know anything, something about anything? So this is once, if you want to click this, you can, this is my approach. First, I look at the industry. First, I look at the industry, the sector, and I avoid the industry which I don't want. So I avoid normally the pharmaceutical industry. I avoid the stocks which are very highly priced, like some group which is recently come down to second position. Okay, that group. I'm avoiding that group because their valuations are extremely, extremely high. Some people still buy it. Similarly, some of them buy the new age platform-based stocks. You need to look at the profitability of these companies. Are the companies going to become profitable in next 3 years, 4 years? If they are going to be, buy at that point of time, not now. Because you don't know whether these companies will survive in the next 10 years in the current format. So my first step is a top-down approach on the company, the market, the industry, and the Indian sectors itself. Okay, the environment, the Nifty. The second thing is screening of stocks based on the data, which is a part of the bottoms-up approach. So deep dive into your filters, and then you screen some 50, 60, and out of 50, 60, finally you come down to 10. Recently, I've given some 3-4 names of my core portfolio 2. Core portfolio 1, I had suggested some 10-12 months. And core portfolio 2 is the one which I'm working on it. I already suggested some 4 stocks. 3 of them are doing excellently well just now. Okay, I don't want you to buy those. I'm just showing you the method of doing it. And for each stock, go into deep dive into the fundamentals, valuations, current performance, last few quarter performance, technicals, governance, which bucket they are, how will they perform, what are the. So you need to look at some of this. Basically, I was wanting to show you something. These are the sites which I refer. I go deep dive into them, and I cannot stick to 1 or 2 because some of them give you some difference and some of them doesn't give you the information. So you have to refer some of the other sites also for a better idea. And this is my, for each stock, I will go to this level, and one more is corporate governance. So you have to take on these levels. And then you decide whether you should buy a stock. Many of us only go by the price of the stock. So if you decide on the bucket, which is whether the sector is having a tailwind, whether the company will move forward, whereas the longevity is there, all these things are very important for the company to do well. So fundamentals should be minimum, average, or moderate, or in an improving manner, or good or excellent. It cannot be poor or below average. You should not even touch those stocks. Valuations, you may have to compromise sometimes on picking up some expensive stocks. Okay, like Tata Elxsi, which is a good stock, but it is very highly priced. So what I've decided, I'm reducing my numbers and I'm waiting for, so from 2030, I have now reduced to only 3. I'm making profits on that stock from 3,000 level till 8,000 level, 8,500 levels. Now, what is the objective? I want you to move ahead. When the stock comes down to 5,000, 6,000 levels, you can once again enter the stock. Quarter performance, every quarter, look at the performance and go back and check on the last 2 or 3 quarters. Is the company turning around? Some companies are always moving in the upper circuits. Avoid them, because as they move in the upper circuits, so will they move in the lower circuits. And when they move in the lower circuits, you'll not even have the time to exit the stock. Look at the corporate governance. Look at the management team. Look at the pledging. Look at the promoter holding. All these are very important parts. You will have to use the tools for all these things. Okay. So I end my lecture here. If anyone has anything to ask me, you can always do that. You may be finding little too much of a things, but I believe in going into depth whenever I do anything. So the next lecture will be on the Porter's 5 principles, and then we'll see the key ratios. Yeah, you are saying something, somebody? I can't hear you. The voice is breaking. Hello.
Sir, I'm typing.
Mutual funds, I have got some videos on my YouTube. You can go through there are 5 videos, I believe. 4 or 5 are there. How the screening methodology is there, what ratios you should see for the mutual funds. Just go and see them, because after fundamentals, I will be taking up mutual funds. So fundamentals, few more lectures are there, about 4 or 5, and then I will take the mutual funds. So in the meantime, you can have a look on the videos are there on the YouTube. You can search in Vira Fadajania, and then you'll be seeing mutual funds videos are there. Okay, we close for the day.